Hello and welcome to Portfolio Matters, weekly markets checklist week 201.
Wow.
And trigger warning, we're going to be talking about the budget. But before we get going, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end.
First of all, the news. So we had the UK budget. I suspect that didn't improve anyone's mood, and we've got long sections coming on that. I know you don't want to hear it, but we've got to go through it. So peace talks continue between Russia and Ukraine, but with little progress so far. NATO has separately threatened to be more assertive against Russian hybrid warfare attacks, such as sending drones into airspace around European airports, etc. Let's see what that develops into. Donald Trump has promised Americans $2,000 checks from the proceeds of tariffs. That would be inflationary if it happens. And markets think it may happen, actually. Now, really important, the following stress tests, the Bank of England Financial Policy Committee has announced that it will lower the amount of capital that UK banks need to hold from 14% to 13%. And the FT estimates that will release up to 30 billion of bank capital that can be used for further lending. That is great news for banks and great news for the UK economy. Now, previously, we have talked about how the fall in UK productivity and UK GDP growth post GFC is likely caused by the tightening of bank capital requirements, leading to them not lending to small businesses. Now, this may help, and this is great news for the UK economy. In economic news, very little macroeconomic data. EU inflation came in slightly hot, rising to 2.2% above expectations, but core inflation actually came in slightly soft and was unchanged at 2.4%. In the US, the Bureau of Labor Statistics continues to catch up after the shutdown. So most of the data is months behind, and actually for September. The contemporaneous data, we've had the ISM manufacturing, which was weak, and the ISM services, which was okay. Market news, well, after a brief wobble last episode, the bull markets are back everywhere. The Russell 2000 rose an astonishing 6% over the last 10 days. All equity markets have done well. Industrial metals have had an astonishing couple of weeks. Copper was up 6.4%, tin up 5.3%. Oil actually was up a bit. European gas prices, this is great news, continue to be weak despite the cold snap. US natural gas prices were very strong. Precious metals had an astonishing 10 days. Richard will be pleased. Silver was up an amazing 15%, as Richard had been forecasting, and gold was up 3.4%. All the precious metals were up, and even UK bonds were okay. And after Rachel Reeves failed to fuck it up, basically, despite her best efforts. So
No bias there, then, Keith.
yeah, I know. Well, we're fed up with the government, frankly. After I was initially quite optimistic, but that's gone.
Likewise. Likewise.
Um, so this is an interesting chart, actually. This is chart of the S&P 500 and the odds of a December rate cut. So equity markets appear to be rallying in line with expectations for the Fed easing next month. Sorry, this month. And that's odd because markets are increasingly convinced that Trump will nominate his flunky Kevin Hassett as the next Fed chairman. I'm going to read this out. The appointment tells you whether or not you're going to have an independent Fed. If you have Waller, you have an independent Fed. Hazlitt is the most political choice you can get next to appointing Donald Jr. It's widely perceived he'd be very obedient to the president. And that's from Joseph Wang, who's like Fed guy. And if Hazlitt comes in, then he's likely to cut rates in line with Donald Trump's wishes. Now, this is Bank of England's capital requirements for banks. Both the US and the UK look like they're going to be easing capital requirements for banks. That is good news for the economy and for lending. In contrast, the EU and Switzerland look like they're going to be tightening it, and that will be very bad for the EU and actually means that EU-like growth will continue to be weak and interest rates will have to be lowered. Markets are increasingly confident that the Fed will cut. And they're putting a 25% chance that the Trump will actually go through with his stimulus checks. That would be good for the US economy, but bad for inflation. Meanwhile, 24 cents of every dollar raised by the US in tax revenue goes to interest payments. The US needs to get its deficit under control and fast. And everything's rallied. So not only have equities rallied, but credit markets have rallied as well, completely reversing the rise in yields we saw after the failures of Tricolor and First Brands, which we covered on the podcast. Oil actually has been stable. We've got a bit of an oil coming up, but this week there were 4 attacks on Russian oil tankers. Now, none of these seem to have caused oil spills, but 3 in the Black Sea and 1 off the coast of Senegal. You have to think that Ukraine is widening its attacks on Russian assets all around the world.
This is Ukraine with a, in inverted commas, Keith, really, isn't it? Because effectively it's a proxy war now.
Yeah. But it's not clear how the one in Senegal, it's not clear how they achieved that to me. And the other thing they've done is they sent a remote controlled explosive boat to the mooring where oil from Kazakhstan is exported via the Black Sea. Now, 2 of those moorings appear to have been repaired, but 1 is permanently out of action. So it is disrupting Russian oil flows a bit. And onto equities. Richard.
Thank you, Keith. So as Keith said, it was a storming week, basically, for everything except the VIX, which is exactly what you'd expect if everything else was storming away. So the FTSE All World was up 3.6%, the All Share up 1.8%, Stocks Europe up 2.5%, S&P 500 3.7%, Russell's 2000 up 6%, although a meager 12% year to date. The Nasdaq up 5% and 21% year to date, and the Hang Seng only up 0.9%, but up nearly 30% year to date. Topics up 3%. Bitcoin, after a torrid few weeks, rallied 7.2% and is now 0.8%, almost unchanged on the year. The dollar fell quite heavily over the last few days. The pound's up 1.5%. And 6% in the year to date, and the euro also up 1.2%, and the euro is up 12.7% year to date against the dollar, with the dollar index down nearly 9% year to date, and the VIX down 31%. So it's the FTSE All World Equity Index.
Yep, almost back to its previous highs.
Yeah.
The Santa rally is on.
The FTSE All Share. Euro Stocks 600, S&P 500, Nasdaq Composite, the Russell 2000.
That is a really strong rise.
Yeah. The Hang Seng. Topics. Bitcoin and pound against US dollar. The euro against the US dollar. And there's the dollar index. But I should say I'm a bit irritated that the pound has risen against the dollar for purely personal, selfish reasons.
Why?
Because all commodities are priced in dollars.
Oh, I see. Yeah.
The VIX, which is sort of back down to it's this very, very low level that has now become the norm.
Yeah. Astonishing.
A bad year for active managements. So only 22% of active funds beat the market, which is you'd expect like 45% to beat and something like that.
Yeah.
So
Yeah.
this suggests that basically, if you're employing an active manager, you've got to be really careful about which one you're picking and why.
Yeah. So I've been currently working on a big section, which we're not going to do this week, about how to invest when CGT is like 24%.
Mm,
And actually, you don't want to invest in
yeah,
active funds, in part because they underperform, but also because they underperform, they don't tend to survive that long. So, whereas index funds last forever, active funds come and go, and therefore, you're likely to be kicked out of them and crystallize a CGT bill. And I'm
or
working on that with Mr. C. Peckham, so that's coming up.
interesting. Or in this case, by the look of it, Keith crystallizes a CGT loss relief.
I don't think it's that bad. It's just you underperform the index.
So you have the Mag 7, which is transitioning from capital light to capital intensive business model.
Yeah.
Which obviously, I mean, what's really interesting is that OpenAI has got itself committed to something like 300 billion or 400 billion, I think, capital expenditure over the next few years with revenues of not very
Yeah,
much.
exactly.
And I read yesterday, I think it was yesterday, maybe the day before, yet another, Altman has done yet another deal. And you do have to sense that this thing is spiraling out of control.
Desperation, I think.
Yeah.
We've got a big section on Gemini 3 and on ChatGPT coming up, both those
And
coming up.
Gemini 3 is the Google one, isn't it?
It is.
Yeah. So we have financial conditions which are loosening, and obviously with interest rate cuts, that will continue to happen, which should be good for markets. I mean, you also wonder whether we are at some point going to get more QE. I think it's probably inevitable. It's just a question of timing. And momentum had a bad month, so Nvidia underperforming here.
Yes, absolutely. And that is related to Gemini 3, so we'll talk about that later.
And yeah, so Google have created their own chips, haven't they? TPUs. What does a T stand for?
I've forgotten.
Something processing unit, presumably
Yeah.
rather than NVIDIA. So NVIDIA has now got competition for its GPUs. So the TPU is a tensor processing unit. And we'll ask our own AI, Keith, what tensor means in a few minutes.
Oh, shit. I'll have to look that up as well.
So I mean, the market is still continuing NVIDIA's revenues to grow very strongly, but its margins have fallen from 78% to 73%. So, I mean, obviously there is competition is going to arise in this market, and presumably there is at some point going to be some Chinese competition as well.
Yeah.
We shall
Yes.
see how that. But the I guess NVIDIA's first move advantage is slowly going to be normalized.
Yeah, that's my expectation.
Google's seen its PE ratio rise from 16 to 28 over the course of the last 6 months or so,
Yeah.
which is a lot. And clearly, Google is doing the right things in terms of plowing. It has the resources to plow its own furrow, and it's doing it.
Yeah. Amazing, though. That's amazing.
It's a very clever business strategy not to tie its wagon to the NVIDIA, or however you pronounce it, the NVIDIA horse.
Yeah.
And Oracle shares are slowly drifting, though. Oracle have got a big deal, haven't they, with OpenAI, which one wonders is ever going to be fulfilled.
Yeah. So we covered that last week. So the market appears to be strongly differentiating between Google and ChatGPT in favor of Google and
Yeah.
Gemini 3.
big tech companies which no longer fund even. So big tech companies can no longer fund data center spending from cash flow. So they're borrowing. Now, I always think that when companies borrow large sums of money for capital investment, they are increasing their risk.
Yeah.
And we'll watch this space, I guess. These are very large sums of money that are being borrowed. So the Russell Microcap ETF includes the smallest 1,000 stocks in the Russell 2000, and it's hit an all-time high. And look at that for a run if you just stuck in
Yeah.
it.
Yes, absolutely. Stocks for the long term.
So this supports my thesis that the US is not going into recession anytime soon, despite the fact that there are some tricky parts of the US economy.
Yeah, the thing is, Richard, having held out for a long time, I've come to your conclusion, and actually, the reason I think the US is going to avoid a recession is that Trump is going to cut the capital requirements for banks. And that's same here. And interest rates are going to come down. And yes, there's a lot. The labor market is slowing, but I don't see the big rise in layoffs yet. Now, this is all subject to revision every time we do the podcast, but
Yeah.
so far we are just not seeing the rise in layoffs that you would expect to start the negative feedback loop that causes a recession. In particular, construction activity is just being held up by AI data centers. Now, at some stage, that comes to an end. Then all bets are off. But right now, it's not happening.
No, I completely agree. This is an interesting chart, isn't it? So basically, this is Zoom, and obviously it had the COVID, phenomenal COVID rise, and now it has well nearly quadrupled or tripled its. Its income has gone up by 1,000-fold,
Yeah.
and its share price has dropped by 70% or whatever.
Yeah.
I would like to know what its profitability is actually.
That's a very good question. But I mean, we pay for it. We record this podcast using Zoom. But the analogy for me is an Nvidia. It's how much growth is already in the price.
Mm.
At some stage, I really think Nvidia's margins will fall back to earth as competition arises.
So I'm just having a quick look. So Zoom has a market cap of 25 billion, price to earnings ratio of 16.
Cheap.
This is not a recommendation, but
No.
uh, as Keith, as imitating a chicken in his back garden, like saying cheap, it does look like quite an interesting proposition, doesn't it?
Don't know. So, technology, isn't that going to be free at some stage? Yeah, it's very difficult to have maintain margins, I'd have thought.
Yeah, although Zoom, I think, has carved itself out a bit of a niche. Of course, it competes with Microsoft, doesn't it, and Teams,
Yeah,
and Google with Google Meet. Anyway, interesting. So poor old strategy. This chart looks very, very sick. I mean, I can't help but wonder whether there's been a bit of support going on in strategy and Bitcoin recently
mm,
because there's been this sudden surge
yes,
upwards, and strategy isn't that far off from being in serious trouble.
yeah,
We shall see. I mean, to my mind, Bitcoin is an investment in nothing.
yeah. No, I totally agree. It's a meme. It doesn't have any value at all,
Yeah.
apart from trying to sell it to the next sucker.
So, they're creating $1.4 billion reserve to cover 12 months of dividends out of unrealized profits, presumably. But
Yeah,
it's highly exposed to the Bitcoin market, and there we are.
yeah. Because the thing is, essentially, he's saying that Bitcoin, all the assets are in Bitcoin, but his liabilities are in dollars. So,
Yeah.
yeah, The whole thing doesn't make any sense to me.
No.
Anyway, on to commodities. Quick summary. Well, oil was firm, but all the investment banks are very pessimistic about 2026. We'll take you through that. Now, EU and UK natural gas futures hit new lows despite the cold weather. Hurrah! Meanwhile, US natural gas futures hit new highs. So, what is happening is that US LNG exports continue to hit new highs and will continue to do so. And that is um, narrowing the gap in prices between European and US natural gas prices. That's great news for us, not so good news for the Americans. Industrial metals were universally strong. Precious metals, amazing. Richard must be ecstatic. So, energy. So, when we talked last time about the future demand for fossil fuels, and the bottom line is that the richer you are, the more energy you need. There is no such thing as a rich, energy efficient country or
So
energy poor country.
the interesting point here is that basically the more complex the system is, the more energy it requires to sustain itself. And uh, you can't have a complex society if you don't have energy, which is what Keith has just said. But our society is rapidly, the Western society is rapidly becoming more complex because it's using AI, which is incredibly complex, and
Mm,
AI requires a vast amount of energy. So it's a continuation of that thesis that
yes.
as complexity increases, energy consumption goes up, which is why the world is never going to start reducing its energy consumption. It may find alternative sources to fossil fuels, but it's not going to reduce its consumption unless
Well,
it becomes less complex.
yeah. Well, I totally agree, Richard. But the way I would rationalize what's happening is that so the Industrial Revolution was the UK, the Brits discovering how to substitute coal for human labor. You know? So that's coal for raw power. Now, we, the Americans, actually mainly, have discovered how to substitute electricity for human brain power, but both require vast amounts of energy. And
Yes,
so
that's a good
we're
point, Keith. I hadn't thought of it that way.
we're as that continues, we're going to be substitute, we're going to need more electricity and everything that entails. So this week, Brent was pretty stable, up 60 to 63, above $60 a barrel. WTI had a bit of a bounce. They're both down on the year. But this is great news. We're in winter and Dutch natural gas futures down 6%. UK natural gas futures down 5.7%, down 44% and 41% on the year. Brilliant. Great for inflation, great for households. In contrast, US natural gas futures up 10% and up 40% on the year. Coal down a bit, down 13% on the year. Uranium flattish, up 4.5% on the year. So this is Brent, pretty stable towards its lows. WTI similar, but still below $60 a barrel. Numbers specific to the oil market. No, we haven't got November numbers for global oil inventories yet. In the US, we've had quite a big build over the last 10 days since the last podcast. So the US market oversupplied. US crude production pretty stable at 13.8 million barrels a day. That's up almost 250,000 barrels a day since the start of the year, despite the falling rig count. Amazing. This is a chart of Russian seaborne exports and is exactly what you'd expect, basically. So exports from Lukoil and Rosneft have fallen, but then, it's sneaking out elsewhere. It's not clear it's had any real effect, frankly. And this is the oil forecast for next year. Goldman Sachs 40. Go on.
I'm bullish for oil for next year.
Really? Very good. Okay. You heard it from Richard first.
I'm a contrarian.
Yeah. Well, you've done incredibly well, Richard. So,
But
congrats.
don't jinx it, Keith.
Yeah. Well, everything I've touched has turned to lead. But anyway, we'll get onto this in a second. So, this is fantastic. This is brilliant for us. European natural gas futures down to 28, UK down to 73. Okay, so I've looked it up. UK electricity prices are about 40% natural gas, which sets the marginal price. So this is brilliant news. In contrast, US natural gas futures rose 10%, up almost 40% on the year, and US LNG exports are up 40% in the year to November to 10.7 million tons. So the price is up because exports are up, even though producers have also been increasing output. And there's also a cold snap in the US currently. So that means utilities are drawing down inventory.
There's
But
a gradual equilibration, isn't there, between US and European prices, basically.
absolutely. And now look at this. This is worldwide. So this is not just US, but this is worldwide LNG export capacity that's forecast or committed to be coming online. That's just astonishing. We're currently at what's that, 12? We're going to go to 28
Mm.
by 2030. There's a lot of natural gas coming via the LNG market. That is great for purchasers. Actually, I'd say that's very bad for coal. So this is coal and uranium, which is kind of flattish. On to industrial metals, Richard.
Thank you, Keith. Um, so generally a good week for all industrial metals looking down there. Aluminium up 3.5%, cobalt up another 3%, so it's more than doubled in the year. Copper up 6%, so up 33% for the year. Iron ore up 3%, lithium up 2%, now up 25% on the year. Neodymium up 3 to 45% on the year. Even nickel managed to scrape a little bit of an increase, although it's down 3% on the year. Tin up 5% to 34% on the year, and zinc up 2% to 2.7% on the year. So it's aluminium, cobalt.
Now, we know that the reason cobalt's up. There's loads of cobalt, but it's all in the DRC, and the government of the DRC are re reducing exports. They put limits on exports, and actually, you can see that China's imports of cobalt have collapsed since they put quotas in place, and if it continues, you could actually get a shortage of cobalt. Now, this is totally uninvestable because at any point the DRC government could open the taps and flood the market. But right now, they're squeezing the price up.
Yeah, interesting. So there's copper.
Looks very strong. So this chart is from UBS, and they're forecasting that mine disruptions will cause the copper price to rise to $13,000 a ton by the end of 2026. Now, this is quite a dramatic chart because it's a chart crime. It doesn't start at zero. So, it's actually only a 15% rise. But, spoiler alert, I bought copper in size over the last 10 days because the more I've thought about, we talked about this last week, and Richard's been onto this for a long time. Um, and I finally reacted. Basically, I can't see a solution to the copper problem. So we know that last week we had a chart of copper discoveries, which are are declining. Essentially, we're not finding any, and grades are falling, and we use vast amounts of it. So I just there's I can't see a solution. Unlike oil, there's loads of it. You just got to go out and find it. Natural gas, loads of it. So any sort of shortage is fixed by just investing in exploration and production. In the case of copper, we've been looking for it for a long time and we just can't find it. We're going to have in my books, the next big frontier is going to be deep sea. It's the only way we can find more copper, and we need more copper. Richard, you got any thoughts?
Um, yeah, I mean, basically, I agree with what you said, Keith. I think that obviously there will be some substitution. Aluminium can substitute to an extent for copper, and in fact does. Yeah, I think in some power transmission cables. But if we're going down the route which we are of electrification of the world, which is obviously the right thing to do in the long term, as we've seen multiple times from multiple different sources, there simply is not enough available metals basically to enable this to happen. I guess what it also means is we've been very profligate with these materials, and we're also going to have to be more careful how we use them, how we recycle them, and maybe not we're going to have to actually be more thrifty with their usage, which will come with time and manufacturing efficiencies and technological advance and so forth. But fundamentally, there isn't enough of this stuff around to achieve what the politicians are aiming for, and that means the price has to go up.
Yeah. So in the new year, when I have time, I'm going to do a big section on copper to
The only
understand
thing that
copper.
will change it to copper, to my mind, is if we manage to develop room temperature or high temperature, as it were, superconductors, and I don't think that's anywhere close just yet.
No. You can now get superconductors which work within the range of liquid nitrogen, but you
Yeah,
then have to create a network of cables which are constantly cooled by liquid nitrogen.
yeah,
I just can't see it.
it's not practical.
Now, while we talk about copper, a lot of money is going into data centers. And according to ChatGPT, a data center requires about 27 tons of copper for every megawatt of power consumption. So that's like all aspects of the data center construction. So that's the cabling, but also the cooling systems, etc., etc. And for AI specific data centers, that might be as much as 66 tons per megawatt. Now, what does that imply? So currently, there's like 35,737 megawatts of data center capacity is being planned in the US alone. So like 27 tons per megawatt. That is one hell of a lot of copper. So I did some sums. So currently there are 7,000 megawatts of data center additions in the US this year, and that will implies 27 tons per megawatt, about 189,000 tons of copper demand. Okay, but we use a lot of copper. We use 28 million tons of copper a year, a hell of a lot. And so that only equates to additional demand of 0.7%. Now, there's an extra 10,000 megawatts of data center starts, and that equates to an extra 1% of demand, and planned capacity is 3.4%. So it's not huge, but I would say it's relatively price insensitive. So,
Yeah,
the main cost is going to be the chips, it's not going to be the copper.
Yeah, it's also additive, isn't it, Keith?
Yeah.
Because electric vehicles are adding to it. Transmission systems from wind and solar power are adding to it. They're all additive, and as you point out, the sources of copper on the planet are limited, and also we've at the moment we've got some interruptions to supply with various of the large producers having particular problems with particular mines. So the overall impact is an increasing demand and a probably relatively stagnant supply.
Yeah. So when I do my piece on copper, we'll cover this. But the big disruption at the moment is the big Grasberg mine in Indonesia, which produces about 4% of world copper.
Mm.
And it had a mudslide, which was really bad and killed 7 people. But the big problem for the Grasberg is that the it's an open pit mine, but then they are doing block mining beneath the open pit. And so when there was this mudslide, it not only affected the open pit, but then it flooded the block mine underneath with mud and sludge, etc., killing 7 people. And then trying to get all that out, millions of tons of mud, etc., is going to take a long time. So they're saying Q2 2026. But mining copper is increasingly difficult. The biggest new discovery, which has changed hands for $4 billion, is on the border between Chile and Argentina, and it's 5,000 meters up in the Andes. Now, 5,000 meters, think about that. That is higher than Mont Blanc. Get it. And copper mining uses a lot of water. Just the technically doing this is going to be incredibly difficult. I mean, the sources of copper are increasingly inaccessible and difficult, basically.
So there's the price of iron ore, lithium, neodymium, nickel, tin.
Yeah, tin is rare in the Earth's crust. And again, like copper, we're not finding more of it.
Mm.
The trouble is, I can't think of any pure play tin miners. If anyone has any suggestions, please dial in. Cornish tin, no.
Zinc and precious metals. So as Keith said, a good week, good year for precious metals. Gold up 3.5%, silver up 15%. So silver's pretty much doubled in the year, but also a good week for platinum and palladium, up 8% and 5% respectively. Rhodium really didn't change, but rhodium was up 73% year to date. So basically, precious metals still outperforming.
Yeah, very good. Well done, Richard.
There's the chart of gold. Thank you, Keith. And Tether is buying gold, which is really quite interesting, actually, because it suggests it's not entirely confident in US debt.
Yeah, absolutely.
And it's buying a lot of gold.
I know.
As you can see from this chart, 26 tons in.
Yeah, I was amazed by this chart.
So I'd like to think that the UK was also buying some gold.
Yes, we've sold it all at what, $350 a ton?
Gordon Brown.
Yeah.
What can you say?
So $350 an ounce. It wasn't that bad.
Talk about prostituting your future.
Yeah, anyway.
So that's the price chart for silver.
Amazing. Absolutely amazing chart.
And platinum. Rhodium. Palladium.
And on to rates. Thank you, Richard. Well, this is the UK yield curve and well up on last year, sadly, despite the despite UK inflation actually coming back under control, and the UK, compared to most governments in the world, being relatively fiscally prudent. I expect that to come down over the coming year. Now, what's really interesting is the market is expecting UK interest rates basically bottom out at around 3.75%, which just seems absolutely absurd to me. We'll take you through the charts in a bit, but UK inflation appears to be rapidly coming under control, and I expect the Bank of England to keep on cutting. This is the US, and unlike the UK, the short end has come right down over the past year, although the far end has has risen as the US continues to run an astonishing deficit of 6.1%. So US inflation expectations are back down to normal, frankly. So you're having real yields in the US of over 2%. Despite Rachel Reeves' budget and fiscal prudence question mark, because we'll take you through the budget in due course, but the budget actually loosened the purse strings in the next few years before once again tightening them later in the parliament. So will she actually go through with the fiscal tightening in the future? Well, the markets are still charging a big premium to lend to the UK. To be fair, that premium largely came in under Liz Truss, but you can see the budget last year put a rocket under it. And this is expectations for interest rates for the coming year. So markets expecting the Fed to keep on cutting, the UK to cut a bit, the ECB not to cut at all, really. Bank of Japan to start raising rates further, question mark. But investors are happy to buy bonds. So this is the bid to cover ratio for, in the grey line, UK gilt auctions, very well covered. 3.5 times. UK having no problem attracting buyers for its high yielding debt. And I thought this was interesting. So Chinese bonds used to yield a lot more than developed market bonds. It now has the lowest bond yields. And that's because its inflation has come down. Inflation matters because actually, when you look at debt levels, China's awful. This is something we don't really cover very much, but China has been using its monopoly power as an autocracy to fund all this infrastructure and industrial investment via debt. So this UK 2-year still at 3.75%. Amazing. I really think that's coming right down. UK 10-year stabilized after the shenanigans over the past month where Rachel Reeves reversed her position on income tax rises, causing a big gilt sell-off. That seems to have come back down, thankfully. The same is true for the 30-year. US 10-year, well down from its highs, but not coming any lower. The moron premium that the markets are charging to lend to the UK compared to the US continues to be big. This is German 10-year actually rising. That's concerning. Same for France, Italy, well down from its highs. So unlike the German bond yields rising as Germany increases its fiscal deficit. Italy relatively liked by the markets. There's Greece, Japan in a bad way. Bond yields constantly rising. Okay, and on to this week's economic data. So, quick summary, not much has changed basically. UK stagflation turning to stagnation, EU stagnation, US fine, but late day market softening. Again, we have very limited data. And China, once again, the latest data appears to be showing the economy slowing. Richard, the UK.
So the Bank of England consumer credit figures actually fairly stable, bumping up and down around a billion even pounds per month, as it has been for the last 2 to 3 years. UK net mortgage lending, likewise, I would say, but relatively stable. That goes back to it doesn't cover the period of the budget. I think things slowed down just before the budget, where people were very uncertain as to what was in the works. But I would expect to be not see. Well, I don't know actually. I don't know what the mansion tax will do. Anyway, we'll probably come on to that later. So
yeah,
lending to individuals, again looking perfectly healthy, I would say. UK car production sort of continuing it's perked out the last couple of months, but basically continuing its long-term demise.
yeah. This is Brexit clearly had a very bad effect on UK car manufacturing.
Yeah. Halifax house prices. So the rate of increase of house prices is falling slightly.
Yeah, but actually up in November, I was very surprised by this.
And the economic surprise index, jobs postings actually started to perk up slightly
Yeah,
after a
I was,
long period of decline.
yeah, I was surprised by this. We talked about this last time, but the trend has continued. Now, is this just seasonal? I would say it's not just seasonal because actually it's been going on for
Yeah,
much of the year. We do seem to have bottomed.
we do. UK true inflation at 1.4%.
Yeah. Now, let's hope this is directionally right because,
Mm,
as we have said many times, we stopped covering this because, clearly UK inflation wasn't below 1% in
yes.
March last year. But, if this is directionally right and it took another big jump lower in start of December, that means UK inflation will be coming right down. And if that happens, I fully expect the UK Bank of England to keep on cutting because, as we've shown you the data every few weeks, the UK economy ain't doing well.
Yeah, that's very true. So permanent placements and temporary billings index, the first rise in temporary billings for 2 years, which suggests maybe the service sector is perhaps starting to pick
Yeah.
up a little bit. And so, in summary, not very much new data. Consumer credit and mortgage lending maybe been a bit weak in October, but I would say nothing out of the ordinary in terms of
Yeah.
previous months. Car production dire, house prices rising, and but a slower rate than previously. And jobs posting suggest the jobs market is stabilizing. So we shall see.
Yeah. And onto the EU. So we had inflation numbers for November, the flash numbers, and month on month actually down 0.3% in line, but year on year it rose to 2.2%. I mean, really nothing to worry about, frankly. The core was at 2.4%. That was slightly better than expectations. A producer price inflation, again, nothing to worry about, down 0.5% year on year. No inflationary pressures really. Unemployment was stable at 6.4%. It was expected to fall, actually, but didn't. Loans to companies, 2.9%. That's actually improving. Loans to households also improving, getting back to normal. This all looks like the EU economy is basically returning to pre-COVID norms of, very low inflation growth. You know, um, economic optimism still a bit shit, but not going anywhere. Industrial sentiment poor, not going anywhere. Services sentiment okay-ish, but weak. Consumer inflation expectations rising again, not great. ECB consumer inflation expectations rising again, not great. Selling price expectations rising again, not great. So markets, well, consumers are concerned about inflation. Economic surprise index, pretty close to neutral. Like the UK, indeed, job postings in Germany appear to have bottomed out. And France, I don't think you can say that yet. Talked about this before, but reminder, since 2017, 44% of new French public debt has been spent on pensions. And the new Prime Minister has reversed Macron's attempt to raise the pension age from 62 to 64. So it's back down to 62. Just totally unaffordable. EU summary, stagnation.
You do wonder how France is going to resolve, because it has to resolve at some point.
It does, yeah. And it doesn't have any realistic plan to get its deficit under control. And the public just won't vote for any form of fiscal consolidation. What's going to happen?
Yeah, and in which case there'll have to be a crisis.
Yeah.
Which will be a debt crisis.
Yeah, no, I completely agree with that. And everyone thinks the euro is stable and will last forever. I really don't think that's true. And, your big position in gold and silver, well, that could go to the moon. On to the US, Richard.
Thanks, Keith. So US unemployment was actually down in November slightly, so that it's showing like a slightly negative trend, really.
Yeah, labour market weak.
Yeah. PPI month on month was
so Richard, all this data is for September, so we just rush through it basically.
Yeah, okay. So the PPI month on month is 0.3% and year on year 2.7%. Core month on month was 0.1% and year on year was 2.6%. Retail sales month on month 0.2% and year on year 4.3%.
Yeah, that's right. Looks okay.
Yeah. Industrial production month on month 0.1%, year on year 1.6%. And durable goods orders month on month 0.5%. The manufacturing PMIs for November 48.2, which is slightly down.
Yeah, so below 50. It's been below 50 for a while.
Yeah. The manufacturing employment was 44, which is continuing the long-term downtrend from 2021. And the manufacturing new orders was 47.4, which again is down.
Yeah. So tariffs not causing a resurgence in US manufacturing?
Not yet, at any rate. Services PMI was 52.6.
Decent.
Yep. And services employment PMI was 48.9.
So employment's still falling, but at a slower pace.
Yeah. So services new orders PMI 52.9.
Yeah.
Quite a lot below expectations.
Yeah, but still above 50.
Yeah. And conference board investors' confidence was 88.7. So that's on a general downtrend, which has been reinforced by the reading in November.
Yeah, sorry, that should read consumer confidence, not investor confidence.
And the economic optimism index 47.9, so jumping up a bit.
Yeah, this is a survey of US consumers, so they're feeling a bit more positive in December.
So the case Schiller index month on month down 0.5, but year on year is up 1.4.
Yeah, but we've now had a few months in a row of falling US house prices. That's quite interesting. That's quite rare.
Yeah. Existing home sales basically at the average level that they've been at now for the last 2 years. Initial jobless claims falling, and continuing jobless claims basically have been stable since early summer.
Yeah, I agree.
And warn notices of mass layoffs, they are rising to an extent. So it's the highest since the mid-2000s.
Yeah.
Indeed, jobs postings index, is that turning up or is it just part of the downtrend?
Yeah. Question is this seasonal? Not
Um,
sure.
and link up jobs postings are falling, having had a little bit of a plateau.
Yeah.
The Dallas Fed GDP estimate, weekly estimate 2.1. The Atlanta Fed is nearly 4%.
Yeah, this is for Q3, but still that's strong.
Yes. New York Fed GDP nowcast 2.3%.
Absolutely fine.
And St. Louis 0.48%.
Yeah, that's for Q3.
As the Economic Surprise Index.
Yeah. So the US economy is doing fine, frankly.
Yeah. True inflation 3.5%. Tariff revenue is rising, now above 30 billion.
This is trucking volumes. And previously, we had talked about how trucking was in a recession, but you're looking at the white line is 2025, the green line is 2024. And so throughout this chart, most of it, you've seen that the white line is well below the green line. So you've seen much lower trucking volumes this year. But then for Black Friday, you saw a huge surge in trucking volumes. So for that period, the two normalized. So to me, that is evidence that the US consumer is increasingly price sensitive and has basically waited till Black Friday to do a load of shopping.
Mm.
So further evidence that US consumers ain't doing that great.
Yeah, interesting. So the paycheck small businesses jobs data showing slight improvement in employment, but it did fall in September and October. And Goldman Sachs layoff tracker, a bit like the WARN notices, rising.
Rising. And you notice when it gets going, it tends to keep on rising.
Mm. And US credit applicants are having their applications rejected more often at the moment, presumably because the banks are being more selective and consumers are coming through with worse conditions.
Yeah.
US gasoline prices are really very low,
Yeah.
affecting
Amazing.
low oil prices.
Yeah. That's great for inflation.
And inequality in the US has been rising actually since 1980 on this, according to this chart,
Mm,
and it is still rising.
yeah.
And capex by the large cap tech sector versus everybody else. The capex of everybody
Yeah.
else is in the long term, very slow long term decline. Really,
Yeah.
tech sector is spending, but this is partly a reflection of the changing nature of the economy.
Yeah.
Various other cyclical sectors are showing weakening. So,
Yeah. So equipment investment rising, everything else not.
Yeah.
So this is the blue one's the important one. Actually, if that starts to roll over, then you expect to see the US economy slowing. Let's see. It's the US economy seems full of contradictions at the moment. The consumer is weak, but AI investment is strong and not slowing.
Yeah. It's undergoing a sort of a sea change, isn't it? It's like the introduction, as you said earlier, it's like the introduction of the steam engine.
Yeah.
So there's the summary. The bottom line is the US economy continuing to tick along nicely, but the labour market may be showing some weakening signs.
Okay, thank you, Richard. On to China. So we had PMIs basically only. This is the National Bureau of Statistics. 49.2 for manufacturing, which is below 50, so not great. Services, non-manufacturing, 49.5, not great. Actually, so that suggests that the Chinese economy is actually slowing, going into a recession below 50. Now we have a new series. This is Rating Dog, which is part of the S&P, and it's saying manufacturing below 50, but is more optimistic on services. Although even services is slowing, but it remains above 50. So they're saying the Chinese economy is still expanding, but is weakening. I thought this was interesting. So this is the processing performance of Chinese chips in red versus the global leaders, Nvidia, at the top, but getting better. Fully expect them to keep on catching up. And pause, take a look at this, but it is amazing that the Chinese state has been very effective in directed investment. So when you look at the productivity in, say, photovoltaic cells or EVs, it's been really good. Now, the trouble with state-directed investment is it's good until it ain't. And there's no reason to believe that state-directed investment is more productive or better long term than free markets. It can just go on longer until you get to a debt crisis. And we know that China has got very high debt levels. So, like France, there is a sustainability question. Bottom line, PMI is falling. Is the Chinese economy slowing? Question mark. And onto one chart. So this chart shows the percentage of companies by sector that have discussed AI in the context of their workforce. And what Goldman is saying is that while they don't find a relationship between labour market outcomes and AI exposure, companies that discussed AI in the context of their workforce have cut job openings more sharply this year. Now, separately, King's College London have analysed the UK job market via job postings and LinkedIn profiles, and they used the period 2021 to 2025. And they're saying AI has had a clear impact on the jobs market, particularly since the release of ChatGPT in November 2022. So the impact has varied widely depending on the susceptibility of jobs to AI, as you would expect. Firms whose workforces are highly exposed to AI reduced total employment by 4.5% on average, which is a lot, and the effect was concentrated almost entirely in junior positions, which fell by 5.8%. Highly exposed roles saw a substantial 23% drop in job postings and a 6.3% fall in advertised salaries. Now, bear in mind, this is concentrated in junior positions. And we know that new graduates are finding it increasingly difficult to get jobs. So AI, sadly, definitely is having an effect and is definitely having an effect on entry level positions. Richard, any thoughts?
No, I think we're going to have to give it longer to work out exactly what's happening. Of course, the tricky thing is that it's a moving target, isn't it? AI is getting better, and companies are trying to work out what they can use it for and what it doesn't work for. So we're still in really early stages. I think it's very hard to predict what the likely outcome is going to be, and it would be useful to know the type of role that they think is being excluded by AI.
Well, it's semi-skilled, semi-skilled. So, junior accountant and consultant positions, anything that could be substituted by AI.
Yeah, but I'm interested to know. Sorry, I know it's the same paper, but I'd be interested to know more specifically. I'm looking to it, but more specifically, what type of role, what particular function is being
Right.
removed, and whether it's removed successfully or whether they're just experimenting with removing it and seeing how well it works.
Yeah. Well, what I'd say, we're preempting our discussion of the budget here, is that it's becoming, there's clearly lower demand for junior positions. And, you know, you would, so the salaries are falling. You would want to encourage companies to hire by cutting taxes for, say, for entry level positions, whereas actually what the government is doing is continuing to raise the minimum wage. So, that is not good for lower entry level employment.
Yes, completely agree, Keith.
And onto the UK budget.
Good.
Richard, Goodo.
So, for those of you who don't already know this, the key revenue raising measures for income tax thresholds frozen again, because you're going to put another million people into the high rate tax band. And basically, high rate taxpayers are no longer higher rate earners. Basic and high rate tax on income from property dividends and savings will each go up by 2%. There will be a mansion tax on properties valued at over £2 million from 2028, with some banding rising to 7,500 for those above per annum for those worth above 5 million. And you can imagine all sorts of. Imagine George Osborne having that toy to play with. I can't imagine that Rachel Reeves is going to be any different in terms of the shenanigans future chancellors will get up to, monkeying around with the mansion tax.
Yeah. No, so I'm going to be hit by the mansion tax. And what I really object to is that, if you're going to tax things, everyone should pay something. So I think that, even if it's just like a tenner or, above a million, you should be paying something. And there's an arbitrary minimum of 2 million, and then there's an arbitrary upper of 5 million. So, people who just have whose house is worth 5.1 million, let's say, they end up paying the same tax as somebody whose house is worth 100 million. I mean, how's that
Well,
fair?
well, it was originally going to be set at 1.5 million, wasn't it? I take your point.
Yeah.
But Labour MP said we'll all lose our seats at the next general election if you do that in the southeast.
Yeah, well, they're all going to lose their seats anyway, frankly. But they've set a precedent, and once these taxes come in, it's difficult.
Oh, it
Yeah,
only make it worse. So this
yeah,
tax, the mansion tax, is forecast to raise 400 million. I mean, it's got the danger of causing even more distortions to the housing market over what the stamp duty is already doing to it, which is
mm,
quite horrendous.
yeah,
In a totally unpredictable way for the benefit of raising £400 million, which is like enough to keep Rachel Reeves in coffee and biscuits for a week.
yeah.
So
Now,
I exaggerate slightly. So moving on.
well, actually, before we move on, I don't, as regular viewers will know, that I'm actually really keen on a sort of Henry George style land tax, which would encourage old people with big houses. If you tax like the value of the house, you would encourage old people with big houses who are empty nesters to move out in favor of young families. And you'd actually solve the UK housing crisis in one fell swoop. So if you got rid of the stamp duty, which stops people from moving houses, and taxed people on the value of their houses, you would encourage a more efficient allocation of housing amongst the population. That would be great. But it
Stamp
would
duty.
be, it would be unpopular.
Uh,
And,
stamp,
go on,
stamp duty is a total abortion of a tax
it is.
introduced by George Osborne. Thank you, George, and
Yeah.
made it successively more and more extreme by successive chancellors, and it's totally screwed up the UK property market. And it's a huge barrier to young people getting on the property market. I completely agree with your sentiments there, Keith.
So, absolutely, I don't object to like an increase in the council tax at the higher end, essentially. But what I really object to is the way this has been done. You have to, again, it's Labour saying, oh, somebody else will pay. You know, we're all in this together, basically.
Yeah. So from April 2029, there's a £2,000 cap on salary sacrifice schemes to stop people taking too much advantage of additional contributions to pension funds. Forecast to raise 4.7 billion, which strikes me as being an awful lot. I mean,
It is, isn't
it
it?
does strike me as being an awful lot. I believe it when I see it, actually. Cash ISA limit reduced to 12,000. Stocks and shares ISAs limit unchanged. I actually think that's probably quite a sensible policy.
Well, the thing is, Richard, well, but once again, you can like open a stocks and shares ISA and then buy a bond ISA, or cash ISA.
There are ways around it, aren't there?
Yeah.
Milkshake tax, so milk-based drinks to be added to the soft drinks levy. This is to do with sugar.
Yeah.
Which is probably not a bad thing, but the trouble is it's just yet another little fiddle and complication to the UK tax system, which is already one of the most complex in the world and needs to be simplified, not made more complicated. Fuel duty to rise from September 26, and Mrs. Sunak's 5p cut in fuel excise duty will be reversed to the stages. EVs to pay 3p per mile in road tax. I have two things here. One, I think that's a jolly good thing. I don't think EVs should go tax-free because they use the road network and we have to pay for that. And secondly, how are they going to know what their mileage is? That's my question.
Well, actually, so we've had this debate on the Discord, actually, and somebody sent a fantastic video of Rachel Reeves being asked this question. And she's basically, the answer is you self-declare and then it's checked on your MOT when you put the car in for MOT and they check the mileage. But so the interviewer asks her, but what about new cars? They don't have to have an MOT. And she appears to be unaware that new cars don't need an MOT, and she has no answer to that, and she just avoids the question. Anyway.
Online, moving on.
Yes.
Online gambling due to rise from 25 to 40%, but they're excluding horse racing from that because that would have destroyed the horse racing business. I mean, I'll shut up now. That's the summary.
Yeah.
So, key expenditure measures: reversal of previously announced cuts to welfare, removal of two-child benefit cap, which actually is going to cost a great deal of money. It's something like 8 billion, isn't it? Triple lock to continue. I mean, they just need to get rid of the triple lock before we end up like France. It's so
absolutely.
Obvious.
But again,
so obvious.
You're piling all these taxes on young people, working people.
Yeah.
And then, to fund pensions.
Yeah.
It's immoral, frankly, in my books.
It is. The minimum wage then is going to rise by 4.1% to £12.71, which basically is probably contributing to pricing young people out of the employment market. I'm not saying that it's right, but I don't think the minimum wage is the way to go about it. Rail fares unchanged next year, which is a good thing. Get people off the roads into trains. The energy company obligation scheme introduced by the Conservatives will be scrapped. Will save the house. Most things introduced by the Conservatives are nonsense anyway. So ab initio, sort of a priori, if it was introduced by the Conservatives, it's probably a good idea to scrap it. I speak as a Conservative voter. I'm so fed up with our political system.
Well, I think everyone is at this point. But Rachel Reeves has kind of got religion about inflation, though. So she's like manipulating inflation down by freezing rail fares and reducing electricity prices.
But she's increased fuel duty.
Yeah. But again, if you're going to do it, just do it rather than say, I'm going to increase fuel duty in a few months' time gradually. It's like,
what I want to know is
brought it in, that cut in as a temporary measure. If raising it again will raise a lot of money. You need the money.
What I want to know is when they're going to cut the number of civil servants back to the pre-COVID numbers.
Yeah, agreed. That would require hard choices, Richard.
It would be difficult, Keith, wouldn't it?
Yeah.
Our politicians, they don't do difficult. It's too hard. Oh, that's a difficult one, they say.
Yeah.
Okay. So charts showing spending increases. Initially, big spending increases building up, and then the tax. Basically, we're all living in la land for a couple of years, and then in 2031, just as the new government is thinking, "Christ, what on earth do we do?"
Yeah.
Taxes are start to boom from 2029 onwards. She has basically shoved it out to the next parliament.
Well, she has. And frankly, for week after week on this podcast, I was saying, well, we're going to have fiscal tightening in the budget. Well, did we?
No.
Not really. No, it's like we have fiscal tightening towards the end of the parliament, but you could legitimately ask, given the the spinelessness of this government, whether they actually go through with this.
Right. However, we are not political commentators. This is the Bank of England's inflation forecast. Well, it looks good. I like the right angle shape to the curve at where we are now, roughly speaking. And I think that I like the way they've got a couple of little waves, to give a bit of credibility in 2027, 28. Yeah. And I just think that if I'm right about commodity prices, this is all bunkum.
Well, the thing is, Richard, commodities are relatively small part of the inflation basket. Most of it's just, labor, when you have minimum wage, etc. So I was reading in the FT about how farmers are having a really bad time.
I saw that article.
Yeah. But when you look at how much the price of wheat affects a loaf of bread, it's minuscule.
It is, yeah.
I forget the numbers at the top of my head, but it's like less than 10%.
Yes, this is true, Keith. You are right. I acknowledge that you're right. But I also think the price of oil is going to go up. Let's move on.
Well, we'll talk about that in due course.
Okay. So she's cutting renewable levies, which will result in a £150 one-off reduction in household energy bills. But of course, our energy prices are far too high, we are non-competitive, and we need to cut them very dramatically. I vote for opening up the North Sea, reducing the windfall tax, and getting our oil companies to start producing domestic oil and gas, so that it's A, cheaper, B, the government will actually raise a little bit more tax probably, and C, we are not damaging our balance of payments. The whole thing is completely bonkers.
Yeah.
Ed Miliband, does Ed watch this? Does my pal Ed watch Portfolio Matters? Is he on the Discord?
He should. But the other thing they did, which we haven't covered, is that the windfall tax remains in place on oil and gas.
Yes. And 75%.
Yeah, it's just, so what we're doing is we have gas resources in the North Sea, which we're not developing.
But we're importing it from the US.
Yeah, exactly. So we are, compressing and freezing gas to whatever, minus 200 degrees, whatever, to liquefy it.
Shipping it across the ocean.
Exactly. When we could just be extracting it ourselves.
And then we get Ed Miliband to breathe on it, or talk on it, to regasify it with hot air. Yeah.
Moving on. There's a lot of moving on for this episode.
Okay, moving on from this. So UK electricity prices are 3 times higher than that of the US. And, if we want to be manufacturing competitive, which we do, this is absolutely essential, we need to halve our electricity prices at least. And this is just dreadful. So these tax changes will improve the UK's public borrowing position, and will increase the UK's public borrowing position up towards the top end of the advanced economy league table. To my mind, this is a race to the bottom. Now, people say, well, it's not as high as this, it's not as high as that, and they always use that as an excuse, and it's a race to the bottom.
Well, at least the UK has a plan. The trouble is that once again, what she's done is loosen the purse strings and then promise she's going to tighten them later. And you fear that she's just going to keep on doing that. And actually, we're not ever going to get any fiscal tightening.
The OBR has been systematically optimistic about the path of the UK deficit. I'm reminded of the inflation charts from a couple of years ago.
Yeah. But the thing is, Richard, I don't blame the OBR for this because the trouble is, whenever the deficit looks like it's coming down, governments react by opening the purse strings. I mean, so Jeremy Hunt pre-election cutting income tax by 2p. You know, that is the Tories. Yeah.
Another walking disaster area.
Yes. Well, exactly.
I mean, and the mess he left the NHS in.
Yeah.
I'll just remind everybody he was health secretary for 6 years. So the minimum wage is outstripping inflation yet again. So there's a contradiction here, isn't there? Increasing the minimum. I mean, the issue is that if asset price inflation has basically completely messed up young people who wish to get onto the housing ladder, and asset price inflation is a consequence of not building enough houses and the financialisation of the economy over the since Margaret Thatcher, really.
Well, I mean, I now think that the minimum wage has got to levels where this is bad. It's actually going to be really discouraging hiring. And there's a lot of things you can automate. And if you can possibly not hire, you are going to be really avoiding it.
I mean, there is a sense here, Keith, that actually, and I have no basis in saying this, but if you have a lot of cheap labour coming into an economy, there is a disincentive to increase your productivity because the cost of investment is greater than the cost of cheap labour. And by controlling immigration into this country, a lot of the source of cheap labour is by controlling ensuring the immigration pertains basically to people who bring a skill into this country. You are shutting down one of the sources of cheap labour. The minimum wage is shutting down one of the sources of cheap labour. And that may actually start to contribute to an increase in economy as businesses invest more in capital, productivity. The problem being, of course, that you end up with high levels of youth unemployment.
Yes, absolutely.
Particularly in the current environment with AI potentially displacing entry-level jobs.
Yeah. So can I do this, Richard? So when we talk about the minimum wage, so £12.71 an hour for a 40-hour week equates to £26,500 a year. Now, data from the Institute of Student Employers shows that entry-level employees in sectors like finance and accounting earn a minimum of around 25,726, i.e. below the minimum wage. So the minimum wage is starting to approach the level of graduate salaries. So the question then is, why bother going to university? Let's say you spend 2 years working in a bar on the minimum wage, you will have earned almost 80 grand over those 3 years. In contrast, if you go to, the University of Southeast Anglia, you come out with a pretty worthless degree and 45k in debt. I'm not sure whether there is a University of Southeast Anglia, but there probably is.
Probably just as well, because you'd be slandering them. But yeah, completely. So, I mean, the whole thing is this concept that going to university is universally a good thing. And then also, our students leave university with a massive debt. And then we say, oh, by the way, please pay our triple lock pensions for us.
Exactly. Yeah. Yes. So you're loading them all with debt in order to pay the triple lock. And so this chart shows that actually minimum wage is rapidly approaching the threshold of student loan repayments. So you come out of uni, you get a minimum wage job, and immediately they take 8% of your salary or whatever to repay the minimum wage. Not great. No, sorry, to repay your student loan.
Oh, great. So milkshake have to pay tax Basically, they'll be added to the sugar tax, where the threshold is from 4.5 grams of sugar per 100 ml or more, taxed at 19.4p per litre. Is
Yeah,
that taxed by the manufacturer as it goes out of the manufacturer's gate, presumably?
yeah,
I mean, I think it's
oh,
a good thing because all this sugar, contributes dreadfully to tooth decay and to diabetes and obesity. Look at this:
yeah.
11 grams of sorry, Keith. 11
No,
grams. 11 grams of sugar per 100 mils for a fridge chocolate milkshake. Blimey.
yeah, absolutely. No, I think this is a very good thing, personally. So thank you, Richard. On to the OBR analysis of the budget. And this is all quite depressing, so we're going to go through this quite quickly. So overview, forecast GDP growth for the period has been downgraded from 1.8% to 1.5% due to lower productivity. Now, you'll have seen in the press that prior to the budget, Rachel Reeves was saying, "Well, I'm going to have to raise load taxes because the OBR have lowered productivity forecasts, which means that I'm not going to meet my fiscal forecasts unless I raise taxes." All untrue. Basically, higher wage growth meant that going into the budget, her forecasts would have been largely unchanged. So the budget actually raised taxes to pay for higher welfare spending and to increase her fiscal buffer. So despite the tax rises, the PSBR forecast for the end of this parliament is 6 billion higher than in March due to higher debt servicing costs, higher spending by local authorities and on welfare. And public spending will rise every year throughout the Parliament due to the reversal of welfare cuts and the end of the two-child benefit cap. So public spending will rise by 11 billion in 2029-30 after this budget. Taxes, however, will rise by 26 billion. So borrowing is forecast to fall, though, from 4.5% of GDP now to 1.9% in 2030-31, at which point UK borrowings will be stable and sustainable if all those tax rises go through.
Leave it when I see it, Keith.
Yeah, absolutely. So some charts. So good news, the OBR have upgraded UK GDP growth for 2025, less pessimistic than they were, but then downgraded it for the rest of the parliament. And the NIESR are less optimistic than the OBR. So although the OBR have downgraded their growth forecast, the NIESR think they're still too high, sadly. So if that's true, then Rachel Reeves could come back yet again for more tax rises because the UK economy will be undershooting forecasts. And the one thing she's not going to do is cut welfare spending. So the good news is when you look at the breakdown of UK GDP growth, we are still getting a big contribution from an increase in the workforce, which is in contrast to a lot of European countries. So we're still benefiting from a growing population thanks to strong net migration over the last few years. But that is due to come down. Has that increase in the population been a contributor to the UK's poor productivity growth, as Richard was saying? And will that productivity growth now improve? Question mark. Trend productivity growth has been downgraded. So the yellow line is March, blue line is November. But in all cases, they're forecasting that productivity growth will resume now, having been stagnant for a long time. Now, I also think that what will really help is the Bank of England loosening the capital requirements for banks. Because as we've talked about previously, one of the big problems for the UK is that we don't invest in small growing companies. They find them difficult to fund themselves. And if banks start giving money to small growing companies, that's great for the economy. So the cumulative effect of the OBR's GDP forecast is to reduce UK GDP by a total of 0.9% over the life of this parliament. But good news for Chancellor, they think wage growth will be higher for longer, and that increases the tax take. They're assuming that inflation will come down close to target by 2027-ish, question mark. Now, they're also saying that they think the unemployment rate is going to stabilize. Now, we've been covering this, and the unemployment rate has been rising, and at quite a fast rate, actually. And why they think it's now going to stabilize and come down again, I don't know.
I think it's that concept of wishful thinking, Keith.
Yeah, I think I can't see any reason for that, frankly. So this is the unemployment rate. It's been rising quite sharply. What's going to cause it to come down again? The economy to stabilize? Don't see it.
No, it's a variable in their models.
Yeah. So this shows the net effect of the budget on UK borrowing. So you'll see that you have higher borrowing now and lower borrowing in the future, funded by tax increase in the tax take, essentially starting from next year. But you've had higher debt interest rates. There's big things, welfare. Taxes will rise from 33% of GDP pre-pandemic to 38.5% by the end of this parliament. That is an astonishing rise. And even then, spending is not close to spending. I mean, that is a post-war high in the UK tax take. And that's a huge increase in taxation. And the majority of taxes are delayed to the second half of the parliament. Like the mansion tax doesn't come in until 2028. Freeze in income tax thresholds will continue for the lifetime of this parliament and will suck in more people into the paying income tax and then into the higher bands, and will disproportionately affect lower paid workers. And this is the size of the state over the last 40 years. Just keeps on growing. But all this means the PSBR should fall to below 2% by the end of the parliament if Rachel Reeves follows through with all her tax rises. And that should stabilise the public debt at below 100% of GDP. The good news, well, the main reason she's raised taxes are to rebuild her fiscal buffer. And so it should be 21.7 billion by the end of this parliament, which is still not huge, actually. And the OBR remains pessimistic about gilt yields. So, I mean, I think that's prudent, frankly. Overall, the budget delivered a minuscule amount of fiscal tightening of 2 billion per annum, 0.04% of GDP over the rest of this parliament, as it loosened the purse strings now, but tightened them later. St. Augustine, give me temperance and chastity, but not yet. So the budget is not expected to have much effect on the economy, essentially. Spending, giving money out with one hand and taking it back with the other. But she is manipulating inflation down in the short term, thanks to the fuel duty freeze extension, rail fares freeze, and the energy bills cut. But she's spending it on welfare, changing to welfare spending.
At the next budget, she's going to be introducing a mandate that all electric vehicles have to have an MOT after 1 year and annually thereafter, isn't she?
Well,
It's
yes,
the only solution.
it is. Yeah. The trouble is, that we've talked about relentlessly, is that, the triple lock means that pensioner spending is just going to keep on rising faster than wages. And dead interest rate payments are now 4% of GDP, 10% of government revenues, you know. And QE is estimated to lead to a lifetime loss of 164 billion by 2036 and is costing the Labour government around 12 billion a year. So this is
Bring,
one way the Bank of England subsidised the Tories and is now penalising Labour.
bring back Mark Carney.
Yeah, he ran off at a good time, frankly. So the PSBR has massively overshot forecasts this year, and that's mainly due to higher spending by public corporations, which is actually the Bank of England's gilt holdings. So it's the losses incurred due to QT. But the pace of gilt sales should now slow, thankfully, as the Bank of England slows QT. And bottom line, after all this, the OBR estimates that the Chancellor is on track to meet her fiscal target. Although, the idea that it's somehow symmetrical around target, the risks, is laughable because that if this does come down, she'll just start spending more money.
Yeah,
So this is like the head fiscal headroom compared to other chancellors. And to be fair to her, she's doing better than Jeremy Hunt. I
that's
think,
not difficult.
yeah, I think that's enough. So anyway, bottom line, budget does not actually represent much fiscal tightening. Taxes have risen, but so has expenditure. The net effect on the economy is likely to be limited. Let's leave it there. So this episode is going to be budget only. I produced loads of stuff I want to get through, but we don't have time because, frankly, we've already done, but essentially the whole podcast. But we will do another episode in a week and a half's time, and then we will be talking about oil, copper, etc., etc. But we're going to cut this short now and talk about quickly other charts, Richard.
Thanks, Keith. The American Dream. This is a chart that shows the possibility of how people feel about improving their living standards. And basically, in the 1990s and prior to that, I'm sure most American citizens thought they could improve their living standards. There's very few people disagreed with that precept. Now it has turned around and only around about 25% of people think that they can improve their living standards, which shows that the system has been set up that it doesn't reward hard work and enterprise.
Yeah. So, actually, we don't have time to do it this week, but next time we will be talking about exactly this and the effect on young people. Essentially, there's been a study that shows that when young people feel they can't get on the housing ladder, then they are very demotivated, unsurprisingly.
Not
And
exactly, not the least bit surprised, kids. So taxi rides. We've got paid driverless as opposed to diverless trips in California.
yeah,
And you can see that it's not growing exponentially, but there's significant growth in the number of driverless trips in California. So driverless taxis are heading this way.
they are. Now, this is an astonishing number, though. So, from nothing, like in mid 2023, it's now at 1 million monthly in California. That is a big number.
Mm.
And when we talk about, in the UK, minimum wage, etc., productivity, you're going to be substituting, once again, capital for labor.
Yeah, I think it's inevitable, Keith.
Yeah.
I think it's the next great industrial revolution.
Yeah, I'm particularly looking forward to actually replacing, truck drivers with, you know, are driverless. I mean, that should be easy to achieve, I would have thought. Okay, good news. So thank you to Dan Leeds 1980 for sending me this. So, yeah, vaccination is under attack in the US in particular, where the, conspiracy theories, but it works. And so this is the instance of cervical cancer depending on vaccination status. And in the UK now, all young girls have to have a what's it called?
It's human
Yeah,
papillomavirus.
human papillomavirus vaccination, and the instance of cervical cancer has collapsed. So great, the triumph of science. And concluding comments. Well, it's been an extraordinary year for risk assets. Congratulations to Richard, who's having his house gilded, actually. And the Santa Valley is in full force. Now, okay, this week, I decided after our piece on copper last week, and I was thinking about I can't see a solution to the copper problem. And I thought, well, copper's just going to have to go to a level which discourages demand. Now, as Richard has been saying, you can substitute copper to a limited extent, but a lot of it has already been done because copper is a lot more expensive than it used to be. So if you think about PVC piping in homes and fiber optic cables for communication, all of that will continue. But fundamentally, copper is the best conductor, apart from silver. Silver's an even better conductor, but is even more expensive. So, copper, I bought copper in some size, and in the UK, there are three copper mining ETFs. Now, I've also bought small positions in all the UK listed copper miners, but frankly, they've all got problems. So, briefly, Rio is about 50% iron ore, and there's a big iron ore mine coming online from the DRC, which is going to cause problems for its Western Australian assets. Anglo American is trying to merge with Teck, and that's due to go through in 18 months' time. If that happens, it will create one of the world's largest copper miners, but it's got lots of regulatory hurdles. If it fails, that's probably going to be quite bad for the share price. Antofagasta is expensive and it has had mine disruptions in the Andes. Antalya mining is small properties in Spain, bought that bit of that. Um, Central Asian metals, it's got limited lifetime of its assets. It's basically uses leaching to mine copper waste dumps in Kazakhstan, and essentially its license runs out in 2034, and it hasn't really got many alternative assets. There are probably others, but they escape the top of my head. So what I've mainly bought is the copper ETFs. Now, there are three of them listed in London. There's the Sprott Pure Play Copper Miners ETF, and that's the best performing. That's the one at the top. There's the Global X Copper Miners ETF, and that's performed well. That's the green one. And before I'd really researched this deeply and just wanted to get a position on, I bought the iShares one. And because, frankly, I used to work for iShares, and that turns out to be the worst performing. There you go. So this is the Sprott Pure Play Copper Miners ETF. It's small. Okay, so be aware of that. Its expense ratio is 0.6%, but it is the best performing. But its bid offer spread is likely to be the largest. Now, these are the holdings. Frankly, some odd holdings. I thought, I don't, is that really? Do you really want 16% weighting in China Gold International? So, and Sol Gold, I mean, that's a development asset. So I would be careful, frankly, about the spot pure play copper miners. Global X done well, much bigger, 443 million. That's good size, 0.55%. And this looks sensible. Antofagasta, don't know anything about London. Do you know anything about London, Richard?
Not really, no, Keith.
But these are all the names you'd expect. This is the iShares Copper Mining ETF and 198 million, 0.55%. And again, this looks sensible. So both the Global X and the iShares ETFs look sensible. The Global X one has performed better. And finally, peace may be breaking out between Ukraine and Russia. You will all be aware that Donald Trump is trying to negotiate a peace on unfavorable terms for Ukraine. Now, listed in London is Ferexpo, which has a big iron ore mine in western Ukraine, very badly affected by the war. If peace breaks out, buy this. Well, sorry, that's not advice. I will be buying this because, and I've looked through, it's currently not profitable. Its operations have been very badly hit. It's had loads of its employees drafted into the army. 20 of them have been killed. But if we have peace, it should recover back towards its previous levels. So you're talking multiples. So, watch this space. Okay, I think that's it. Thank you all for watching. We'll be back in a couple of weeks where we won't be talking about the budget, I hope. So,
Fingers crossed.
Fingers crossed. In the meantime, please can you press like and subscribe to the channel. And in the meantime, it's goodbye from Richard Wheater.
And it's goodbye from Keith Jordan. Goodbye.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information, nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.